All right. Good morning, everybody. Just to make sure everybody's hearing me, give me a thumbs up, a yes, a no. Even if you say no, I'll know that you're hearing me. All right. Thanks, Jeff. Awesome. Thanks, Jim. All right. Guys, welcome to the Hurley Investments Trade Findings and Adjustments, March 24th. Today, I kind of want to follow up with some things we talked about at the beginning of the month. This was what I had in here March 3rd. Last time I spoke with you on a trade findings and adjustments webinar. I also talked with you guys on one of the Monday commentaries as well. But a lot of this stuff has gone by. Oops. Just wanted to kind of take a step back and see where we were and where we are and what some ideas, given the current situation, that we could throw together for some possible trades and possible ideas that we could look for to take advantage of. So, last time talked about, beginning of March, coming up with interest rate hikes that we passed. That was the 15th or 16th. And of course, as soon as that happened, everything went up. I have to take a bit of a dig at Kevin, who made fun of me for saying, market has sold off significantly prior to this rate hike event in anticipation of raising interest rates that the Fed is planning on doing. And if it comes to the point where interest rates are raising the way that the market is expecting, then I have a feeling that there's some people waiting on the sidelines. My goodness, people waiting on the sidelines to buy the dip because it's been kind of ridiculously oversold. He said, no, once the rate hikes come in, there's going to be some idiots that just think that are still surprised and are ready to continue to sell off shares of funds and et cetera, et cetera. And I thought, okay, well, why don't we do this? My idea was, let's treat this like an earnings event where, it can go either way. And we'd protected on our shares of stock using puts on several of these trends down. Should draw a little bit of picture here and here. But we had made up a lot of the difference on those big legs down on our shares. So my thought at this point, if we treat this like an earnings event, typically we'll see what we'll consider is if it's already gone down, our shares of a stock have already gone down right before earnings, and we've made some money on puts protecting our shares of stock. What we can do is roll those puts down from a higher strike price that we might have higher, take a profit now that the shares are lower, and add protection on again at that lower strike price. What that allows us to do is, if things go the other way and go back up, we've booked a profit already on puts that if we had kept on they would lose more money as stocks go up than if we had bought new ones that were at a lower strike price down here and it had gone up. But if we were super bullish, obviously we would have booked profit on those puts, bought more shares, and expected it to go up, and everything would have been great. But of course, we didn't know that, so we wanted to keep the protection on. But it benefited us going back up, losing less on those original puts that were at a higher strike price. Higher strike price means if the stock is more in the money, stock's gone down since that strike price, you have some profit there. And if it goes back up while you're holding that, that will lose money quicker than an put option that has a lower strike price closer to the money. I hope that makes sense to most of you. I think it should. But if it doesn't, basically the idea is we still want a protection on, but we want to book some profit and lose less money on that protection in the event that things go back up. So we did that with several shares of stock. Our Apples, Baidu, Disney, Boeing, I think. We did it with a bunch of them. So that looked like it was smart. So now we're in a different situation. We've had a huge bounce back in the market today. It's trying to hold on to getting back over this 200-day on this red line. Had a day where it bounced between the 200 and the 50-day. And now we're trying to build a base of support to continue above that 200-day. So if I'm going to go back, let me put it to you guys. What maybe has changed on what we might need to focus on or be aware of? Let me change this question. What is coming up that we need, or let me say this, what is our current situation that we need to be aware of? I kind of have it written all up there, but there might be some issues, more specific things that you guys can think of. What else do you think I could add here? We've already passed our interest rate hike. Did you guys hear what happened yesterday? What did Powell say yesterday that caused this little red down day right here? Anyone remember or have an idea? Fed Powell basically reiterated what was said on the Fed announcement mid-month. Ida, thanks. More hikes coming. Well, he said that, but that was basically the same thing he said mid-month. What it wasn't even different really. What he said was we are. Oop, I got another comment. Yes, thanks, Jeff. Uh, 50 basis point rate hikes might be needed as opposed to just quarter point, which is what they did on the 15th. So they might need to be more aggressive and doing a couple more 50-point rate hikes. So you're seeing a bounce back today, and that's probably because nothing was really different about that. He's basically just reiterating some things and emphasizing those 50-point rate hikes. We still have a war going on in Ukraine. This was kind of more a speculative thought that someone had suggested with is China gonna invade Taiwan? And certainly we're worried about if that were to happen, we're going to be worried about our chip stocks and all of the RAM and DRAM and all the memory chips and stuff. A lot of it is in Taiwan. Of course, we have gas and oil still crazy. Prices have come down a bit, which is fueled part of what's fueled this run up in the stock markets right now is trading inverse to oil and gas. We still have some supply chain issues. Some countries still trying to open up. I just read that I think it was Singapore just lifted their mask mandates for people outside. So before they didn't want you wearing, they wanted you to wear masks even outside, which if you ask me is pretty silly that they didn't do that sooner, or why was it even ever done, being outside. We still have the possibility that we might take a little dip with tax selling. Again, it might surprise people how much they owe. They're trying to, I would imagine a lot of people are finding that out about right now, starting to turn taxes in. So, anything that you guys might add? I have one I think I'd like to add, but just to make sure, any other thoughts even on or questions on some of the points we have up already? So another one, and this kind of goes along with increasing inflation and Russia and Ukraine, but we have a wheat problem. Ooh, I got another comment. I'll get to those two questions. Give me a sec. I was going to talk about wheat, where Russia and Ukraine produce, I think it was 20%. You guys can fact check me on that, but the prices are increasing. The worry that because Russia and Ukraine are both stockpiling the wheat that they have for using themselves, rather than shipping it abroad. Obviously, that's affecting wheat prices, which is going to affect food prices. And of course, the oil and gas is going to affect everything that needs to be transported with our inflation. And this kind of goes to maybe answering your question, Ida, how inflation affects investing. And then there's the problem with Ukraine being at war and farmers not able to get their spring harvest started. Again, this goes back to the fact that they are not only the only ones producing wheat, but it is a large, significant chunk of the whole pie. And so this is a problem that the rest of the world is going to have to deal with. Maybe encouraging farmers to allocate more resources, land resources, to planting more wheat. But that's a good question, Ida. So how would inflation affect investing? And put that to the whole class here. When prices on consumer goods go up, how does that affect things down the chain? Do you have a comment? Oh, thanks, Jeff. Fertilizer was another big issue. I'll write that. That all kind of goes with the supply chain and inflation issues. All of this here, all of this. Jeff asked, aren't stocks a natural hedge to inflation? Well, typically they outpace the rate of inflation. So in that way, it's not necessarily a hedge to inflation. It's just rather than having your money sitting doing nothing, you can make more having it in the stock market over the long term, as opposed to losing money on, uh, just keeping it in a savings account even, or just keeping it in cash where it would lose value over time because of inflation. But the worry right now and the problem right now is that if inflation continues to be, its rate is so high, 7%, and if it continues to stay there and even continue to go up, that the fact that that affects the prices of everything makes everything more expensive. So even a company that doesn't necessarily have to worry so much about it, like a tech company that they're really just more worried about, if it's Google, their advertising, like Facebook. But the fact that energy costs are going up, that can be a problem. Certainly there's less of a problem for a tech company for them to have to worry about it. This is a lot more of a problem for, grocery products, but anyone that has to ship anything, that's going to be more expensive. It just affects everything down the line. Typically, a lot of companies, they can do okay because their margins stay the same. But there's only so high that prices can go before, the consumer is less and less willing to pay for those things, even if the company's margins are intact, which means they'll have to reduce their margins to try and stay competitive, etc. That's kind of the overall issue. Okay, get to some more questions. I hope that kind of answered your question, Ida, for how inflation affects investing. So what we're going to get to is, given these issues, what are some stocks in spite of the current situation? Jeff, I kind of answered that question with how does inflation affect future earnings? Again, it just goes back to if the cost to make something that a company produces costs more, at some point there's going to be a level, even if they have their margins intact, if the price keeps going up, they're going to either have to reduce their margins to keep prices competitive for consumers to continue to justify buying that product. And that's the problem that you got to look for on earnings, is if that margin is affected. I hope that answered your question. What are some stocks that could do well in spite of the current situation? So all I'm trying to do is I want you guys to start thinking, if I'm going to be putting on a trade of some type, let's say right now it's a bullish trade to buy some dips. Jeff asked us if oil stocks would do well. Typically, oil is a big part of why inflation is up. It's a big contributor to inflation, but that doesn't necessarily mean that oil companies will do well. Sometimes that means people are starting to, look to drive less, look to need gas less. They're trying to look for ways to be less dependent on oil. That can affect how much companies make. And a lot of the oil companies have had a good run up so far already. But you could look at a Marathon, something like that. Destin says, isn't oil really overbought right now? So due for possible big pullback, especially if peace comes. Well, again, it goes back to the margins, and oil seems to make money no matter what. If people are trying to cut back on their use of oil and move to different energy sources because oil is too darn expensive, that's not going to help them grow into the future. If the prices come down and people are like, oh, well, I guess I don't have to worry about finding different energy sources. This is okay for now because it's so cheap. Their margins will do well. So, it just depends. I don't know if they're overbought though. Let me take a look. I know that a lot of them have run pretty high though. Yeah, you can see from this Marathon. And I would think most of them look pretty similar to that. But, we are still heavily dependent on gas and oil. It's not like I'm going to stop driving my car anytime soon. My truck, my 5-liter V8 truck that is super thirsty. But my concern was, just what you said, Destin. They've already made a significant run up. That one we just may have missed. So here's a couple, and what I'm really looking at is what's off its highs, what is going to be less affected by some of these other issues in addition to the oil issue, supply chain, and interest rates. Some of the things that come to my mind first is Apple. Inflation's going to affect them. They'll have raising prices on their stuff too. But what else has Apple got that insulates them much from interest rates, supply chain issues? what helps them through all of that? Jeff, are you saying cash is good right now? Having lots of money from Jim? Okay. I'm not going to say it's bad at this place in our stock market to have, it's not like we're that far off our highs. You know, we're still a good ways off, but cash is good for what though? Oh, Apple has a lot of cash. I'm sorry. I've been asking a bunch of different questions. Thanks, Jeff. Thanks, Jim. They do. They have lots of money. Yes. They've got cash, don't necessarily need to borrow so much, and they can pay the interest. It's not going to be a huge problem for them. Rely less on debt to keep building the company. What else? And sorry, I'll get back to some of those other thoughts and comments. Yes, Jeff, they can buy companies that are cheap, but Apple's also worried about being a monopoly, or at least that the government will see them as a monopoly, and they really haven't done that a lot. Can you think of some of the things that Apple has bought? Because I can think on maybe a couple fingers. Shazam, I mean, as in recently, Shazam and Beats a few years ago. They really don't do the Microsoft thing and just big fish eats the little one all the time. But you're right, it is something they can use. And yes, I wish they would use that more. But really, that cash helps them buy their own stock. It helps them repurchase shares when that happens. When they can repurchase their own shares, that means there's less shares in the market, which means there's less supply, and that pushes their stock price up. Facebook is another one that has that. Facebook has other problems, but Apple, I mean, it's like the market's not terribly off of its high, but they don't have the supply chain issues. Let me make sure I finish my thought here with Apple. They're vertically integrated. Man, I'm terrible at typing. They're vertically integrated and have their own supply chain. They don't need to rely so much on others to do it. Those give Apple an advantage, and I still think they make money through this situation. They've also started to do their own chips, so they're less reliant on Intel. Facebook, we might get a better chance to buy a ridiculous dip. They fell way back after this earnings on February 2nd. They lost 325. I mean, almost that first day, they were almost down 100 points. Got all the way down to 188. And the reason it fell was because Facebook is spending a large amount of money on this metaverse and getting it aggressively set up to get it up and going quicker. They're basically investing in their future growth. Do you think it justifies selling off this much to invest in their future, to make more money in the future? Because I don't. Let me get to those questions in a bit, Jeff. So Facebook, incredibly cheap. And well off its highs. There's a dip you could buy on a good company where that is basically where companies go to advertise. Yes, it goes to Google. Yes, it goes to some of the other social media companies, but they have hundreds of millions of people using their platform, especially during political seasons, and it is still the staple of advertising. Okay, let me get back to some questions here. Let's see. So Jeff asks, does that keep earnings rate up, referring to Apple, by removing shares? What motivates a company to buy their own shares? Well, it's if buying their own shares back increases or decreases the supply and therefore increases the demand, because the demand hasn't changed, that naturally increases the share price. So they're encouraged to do it because it makes their share price go up. A lot of times they'll have it set at different buy points. So like if Apple falls to, you know, a 5 or 10%, they'll have already a buy order to buy certain shares. They award some of those shares to employee benefit programs, that kind of thing. And Apple, because they're so cash rich, they're able to do this really well. And it has significantly helped push their stock price up over the last several years. So why don't all companies do this? Well, not all companies are cash rich. And even if they do have a lot of cash, it's not necessarily good for companies if they're not fundamentally sound. Luckily, Apple doesn't have that problem. They have no problem making good money. But if you think about what's happened after the financial crash in 2008, the GM stock GM was bought by the government, bailed them out, and suddenly they had all this cash, and they just basically went, and the only thing that has really pushed them up to not necessarily where they are right now, because they've been making money, but over the course of the years preceding, or not preceding, but after the financial crisis, when they were bought out, or when they were bailed out by the government, they just used that money to buy shares back. Contrast that with Ford, that's done it all organically. Ford is well off. I guess they're not off their highs right now, but that's really due to the last several years. They've just been doing so well, and finally the market is noticing. But yeah, there's certainly a difference between a company that is fundamentally sound, and has the is undervalued and has the ability to buy their own shares back, keep their stock price held up, supported, that kind of thing. That's what Apple is. GM, not so much. You can say that they've artificially inflated their stock price. You could say the same after the financial crisis with Amazon. Facebook was for a little while, but not. They didn't continue that way. Tesla, Netflix. There was a bunch of them. All right, so Apple, Facebook, and I got to wrap it up here because I'm going way over what I thought I would. I also wanted to talk about Disney, but let me get to some of these other comments. Dustin asked, even if these companies can do well in the current environment, will they still get pulled down with the overall market, mostly by being part of the indexes? The answer, Dustin, is of course, and they already have been. I mean, you can see Apple here, but some of these are just at such an overblown sell-off, especially Facebook, Disney. I'd throw Boeing in here as well, but they have other little issues that they're personally dealing with that you have to be okay with some of the swings there. Which is why, if we're going to do anything with these companies, if you're thinking about a trade, I'm giving you some ideas of stocks that are sound, that could have a bullish run into the future at some point, especially this year. Just looking for things that are a little overblown, sold off, and can handle the current situation. Disney, geez, their parks are open. Everybody and their dog is wanting to go to Disneyland, Disney World. They even got their cruise lines that are going to be coming back. Their subscriber growth is doing awesome on their Disney Plus. It took some subscribers away from Netflix. They had an incredible earnings report. And look where Disney is. They haven't even gotten much of a bounce from that everything else has since the rate hike mid-month. And they have gotten kicked around, rotten red-headed stepchild of the stock market, and right at the time that they've been doing incredibly well, getting business back to usual. Yeah, they could be affected by people not wanting to spend money on travel. but it sure hasn't affected them right now. As high as gas prices are and everything, flights are still not incredibly expensive. It's all still part of the reopening trade that some stocks just have not gotten any love for and should be. So I'd be looking at some of these. Of course, you could look at Boeing and Baidu, but those are going to be volatile, and you know, they've just got their own little issues that, yes, are overblown and stupid, but they're still dealing with them right now. But these ones I think can weather the storm pretty good. So I'd be looking at Leap long call options. Going out to January 23, January 24, June 23, June 24, as in 2024. And being prepared, to your point, Destin, of course, all of these stocks will and have been affected by the situation, and you're just leaving yourself room by buying a leap option rather than shares. You're giving yourself room to dollar cost average and buy them again, double up if it loses half its value in the option, so that you're managing the trade and the trend that way rather than relying on a short-term trend to outguess this market, which right now it's just, given all these issues, it's just not smart. And a lot of you know the strategy with that we've done with leaps, but some of you being new, not sure exactly how much you understand or what you already know. Basically, we're looking to go out a year or more. If it's a Disney, closer you get to the money, the more expensive it is. You could go out of the money and maybe do a 150 January 23 or June 23, January 24. It's going to be a few $1,000s, but it's going to be certainly cheaper than buying 100 shares of stock, about 10% of the value. So in that regard, it's a hedge to stock ownership. This is what I mean by leaps, Jeff. A call option that expires. It's just a long-term call option. That's what a leap is. So we're not looking at going 30 or 60 days or a couple weeks. We're going out a long time to give it plenty of time to make the run and go up that we expect it to at some point. If it goes down, I'll say will cost a few $1,000 per contract. $20 contract is $2,000. Remember, you got to multiply by 100 shares. So the rule of thumb is not to dollar cost average more than 3 times. So let's say you buy a $2,000 contract and the stock doesn't go the way you expect and is dragged down by all these issues, and now that LEAP call option is worth $10 a share, or $1,000 total, you'd buy another one. That decreases your cost basis by 25%, gives you a chance to be profitable before it gets back to that $20 break even. So if you bought one, you'd buy another one. Rule of thumb is only dollar cost average 3 times at the most. Waiting for the option to lose half its value between each time that you dollar cost average. Dollar cost average just means you're buying it at a cheaper price. So you buy one for $20, it goes down, it's now worth $10, and it looks like a good place. And maybe it's a support level, whatnot. If it's not, you can still be patient if it gets cheaper. But that's the time you're looking to buy another one, not another contract. So you're doubling your contracts from 1 to 2. You've lowered your cost basis by half that distance, so 25%. If it continues to go down, it goes down to, let's say it's 5, and now you have another support level, etc. There's other things you feel like it's a good spot to dollar cost average, and then you buy 2 more. So now you have 4, right? That's kind of the most. If you keep doing it, then you risk throwing good money at bad. So you got to be confident in those decisions of when you're dollar cost averaging, but you're just kind of looking for when it's half off. It gives you a better chance that once it starts going back up again, that you can be profitable within that year or 2 time frame that you're looking to profit from a stock. This is, for the most part, what we're doing if we're doing some option trades. It's not going to be, credit spreads and all of the ridiculous, crazy things that you see all the time. It's generally leaps. Sometimes we'll do a bull call leap where you're adding a short option way up in the strike price to lower the cost. I'm just kind of trying to throw out thoughts and ideas to some of you new guys to get you on board with how we look at things. But that's what I would be looking to do with some of these. Does that answer your question a bit, Jeff? And you don't know what we do with leaps? It's kind of the rule of thumb that's been, and obviously if you're gonna be planning on buying a couple more options, you got to leave room to have that cash to be able to buy it, right? So if you have, if you're going to buy it, that go back to that $20 leap contract, you want to leave yourself, another $4,000 or so that you'll be able to dollar cost average just for that position. So you do have to have some cash to buy those dips and dollar cost average. So you got to think of that ahead of time and leave that cash in your account to be able to do it. Just going through some of the questions here, make sure I got everything. Great. So those are my thoughts and ideas, guys. I probably spent way too much time today, but I hope that gives you some things to look at and think about. And there's also the idea that if you already have a bunch of stuff on, you really don't have to do anything. You don't have to be trading every day and every week. Let some things move, let some things go. Have some faith in the decisions you've already made in some of these companies. If you really believe in these companies, then look at them as companies and understand that sometimes the moves you're looking for don't happen in a matter of weeks, but they happen over months and years. Any last questions before we call it a day? All right. Well, I'm not seeing anything come over. Thank you guys for all the thoughts, the questions. Some of you new guys I haven't seen. Jeff, Destin, thanks for your comments. Good to see new names. Got a low battery, which definitely means I need to wrap it up. Hey, thanks guys. It was fun this morning. Have a good weekend. Have a good Friday tomorrow, and we'll see you with Kevin's webinar on Monday. Take care.